Well, thanks for staying with Morning Live. Now, economists have speculated a possible interest rate increase as South Africans await the Reserve Bank monetary policies announcement later today. Now, in January, the Reserve Bank Governor Lesetja Kganyago announced an increase of 25 basis points to 3.75%. Now, for the first time since 2018, we had reached that rate. And at the time, Kganyago said that the hike comes against a backdrop of higher global and local inflation. And this is likely to create a financial distress as the rate increases have financial implications for individuals and households, of course, including bond repayments and vehicle repayments. Now, PricewaterhouseCoopers Chief Economist Lullu Krugel joins us now virtually to talk about the effects of the MPC's decision. Lulu, a pleasure to have you. Welcome to Morning Live.
Thank you so much for having me.
So it's been generally anticipated that interest rates will increase. What is your speculation, firstly, and is it necessarily inevitable, or can we go the other way?
Yeah. So I must say we have penciled in interest rate hikes for every meeting of the Monetary Policy Committee this year. So there's 6 of them in total, and we are expecting interest rate hikes at every meeting. And this was even before we saw the inflationary pressures coming from the conflict in Eastern Europe between Russia and Ukraine. So we've seen inflationary pressures, as you mentioned, coming through from last year already. And in fact, if you look at the US globally, they've reached an inflation rate of more than 7% in January. So something that is unprecedented that we haven't seen in a while. So the Reserve Bank does target an inflation rate between 3% and 6%. So they want inflation to remain within that band. And the governor has expressed in the past that they would rather like inflation to stay around the midpoint of that range, around 4 to 4.5%. So we are getting to a point where we are looking at inflation expectations, because that is what the Reserve Bank consider where inflation might go, and that is getting very, very close to the upper end of that band. So this increases that we are expecting is, as he said, as a result of that inflationary pressure. They do consider growth, but their main focus is on making sure that the inflation rate stays within that range.
So appreciating that, Lulu, but also being cognizant of just the stress that South African consumers and households are currently under. We look at a possible price increase at the pumps, a significant price increase for next month. We know that electricity prices will go up from the 1st of April as well, especially for those consumers who buy directly from Eskom, and that's almost a 10% increase there. And then, of course, if this particular policy, the MPC announces another increase, you're looking at bond prices going up, car notes going up, all of these things, or adding to an already overstretched consumer in South Africa. So if we look back to the previous announcement, the governor, Lesetja Kganyago, said that 3 members of the MPC preferred an increase, while 2 preferred a retention of interest rate. So how tough a decision is it going to be at this point? And I take all you said on board about, inflation targeting and making sure that we keep things steady, but also looking at how consumers are reeling, the pressure we are under at the moment. Really, can they afford to keep it steady, at least for now?
Yeah, it's a very good question, and the answer is complex, because, as you rightfully said, if we look at the source of our inflation, and I think that is at this point in time the big challenge that we're sitting with as South Africa. If you look at a lot of other parts in the world, if you look at Europe, if you look at what we've seen in the US, the inflation that they've experienced before this, I would say before February, was very much as a result of a recovery in the economy and demand pressures starting to build up in the economy. So it is what we as economists call demand pull inflation. Whilst if you look at South Africa and what we've experienced over the last month or so globally as well, it's cost push inflation. It's not something that comes from strong economic growth. It is imported inflation, and that is a debate that the Monetary Policy has had, or Monetary Policy Committee has had for quite some time. Last year, a lot of their decisions to say we keep interest rates on hold, especially towards the latter end of the year, has been as a result of the fact that they did consider that the inflationary pressures that we are experiencing in South Africa is not as a result of a recovering economy, it is imported inflation. So those would be very important implications for them. And as you said, we are in a position where if you look at, for example, lower income households, they spend more than half of their income on food. And we've seen food inflation from yesterday's numbers ticking up quite a bit. So that is all factors that the Reserve Bank will keep in mind. However, they are also sitting with a conundrum that if they don't increase rates soon enough, they might have to do larger increases later on, you know. So my own question was, would it potentially be a 50 basis points increase or a 25 basis points increase this time around? And I'm hoping that they will stick to 25 and not go the 50 route, because there's a real risk that if they do not do it quick enough and in smaller tranches, they might have to react quite desperately almost later on. And that is, I think, something that they would want to avoid.
And Lulu, they did say, the South African Reserve Bank, that they also would rather want to see a gradual rise in the rate, and that this should be sufficient to keep the inflation expectation at manageable levels. But I would imagine that even at the time when that announcement was made, we didn't have the geopolitical situation in the Ukraine, for example. And, you know, you talk about food prices. With the increase at the pumps, we are going to see that knock-on effect, and it's usually significant even with small increases. And now we're looking at, from last month to next month, it's been really astronomical. So let's talk about that. What does that mean, again, for the MPC in terms of just rethinking what needs to be done?
Yeah, so I agree with you. I do know that knock-on effects are significant. You know, when we look at historically, if you look at around a 10% increase in fuel prices, it ends up at about 1.5 percentage points extra in overall inflation in the long term. However, I don't think that the challenge that we are sitting with now is something that the MPC alone can solve. And I think that is where the big difference comes in. The Minister of Finance already announced that they are looking at measures to shield consumers, to see how they can look at the pump prices for fuel. And, you know, the tax increases that we normally expect in April didn't come through. But by no means would that be, or isn't going to come through, but by no means would that be enough. So I think what we're sitting with now is a situation where we can't expect, and where the MPC couldn't actually take care of all of this. They have to consider it, of course, but we also have to look at other measures, and, you know, through fiscal policy or maybe through other measures, government will have to step in, and that's what they are considering at this point in time, because we also can't allow inflation to run away. And we simply don't know how long this conflict could continue. So it's a really tough decision. You know, the Monetary Policy Committee in the past have said that they do not take decisions in a vacuum. They don't only think about inflation. They do look at growth, etc. But they also have a specific task, and then there's other parts of government that, well, they're not government, they're independent, but there are parts of government that could potentially step in and see how we can resolve some of the other challenges that we are sitting with. It is a very, very complex situation at the moment.
It certainly is. And you speak of alternatives, Lulu. So from their perspective, as the South African Reserve Bank, are there any monetary policy instruments that the Reserve Bank can use to cushion this blow? And if we talk about government, what can they do practically to help cushion this blow?
So there's not a lot of options for the Reserve Bank except for maybe holding off on interest rates. We've lowered interest rates significantly during the COVID pandemic, so that was great that we were able to do that. But unfortunately, we are now in an environment where a lot of our counterparts are hiking interest rates. So if we don't do it, it could lead to a weakening of the rand, which in turn could lead to even higher inflation. So it's a bit of a catch-22. The other instrument that they have at their disposal, which would probably not be very effective at the moment, is to say, we are going to buy back bonds. We are going to push additional money into the market. You know, we are going to have open market transactions to make sure that we get more liquidity into the market. That is something that they've done quite a bit of again during the COVID pandemic. So it's not the type of challenge that we are sitting with. So the MPC actually sits with limited options here, except for making a decision on the interest rates. So from government side, something that has been discussed is, do we need a reserve fund perhaps, like we've had in the past, to say we keep some money in the kitty if we get these interest rate increase, the petrol price increases, that we don't have to pass all of that down to the consumer, that we take some of that from a government perspective, we take some of that blow. So that is something that government is looking at, and I know that they are reconsidering. I suppose that's one of the options that the Minister of Finance is talking about, and that would probably be one of the biggest, most effective options they can consider in my mind. It is expensive though. Let's make no mistake, and it will cost government quite a bit of money. So that is probably, in terms of direct options, the one option that they have. Then, of course, there is the grant payments that we're seeing to consumers, especially that additional special COVID grant. We've been talking about a basic income grant for a while. That is something that might take some time, but those are also options that government is considering already. And then I suppose lastly is to look at food prices, and if there's a way to cushion and to help specifically companies that have to import from abroad, to say, okay, we will take a portion of that cost off your hands, because they need to pay for that. You know, they don't have much of a choice. Or if you are a farmer that needs feed, soy prices, for example, is a big problem with chicken feed at this point in time, and we import quite a bit of that. So is there a way that we can support and help directly, you know, in terms of food prices, to make sure that we bring some of that down? And then, of course, the other very complex factor is Eskom and the electricity price increases that we see. NERSA has not allowed that full increase to come through. Maybe that is something that government can again say, let's see if we can't delay that, let's see if we can't do that later, and help both consumers and businesses in that way to take some of the cost off their hands. So I think some of those direct options at this point in time would probably be more effective and more targeted.
And just a final question, Lulu, with regard to what's happening in Ukraine and the impact that it's had on us. You know, the wheat price, for example, has skyrocketed. Fuel prices have skyrocketed. And I was reading something yesterday where India has gone and bought 3 million barrels of Brent crude from Russia at a discounted price, significantly discounted, and allowed to pay in rupees. So if you look at that, all I could think of is, given what we are facing, and given that we are a member of BRICS, and I know, again, it's a very complex situation, but what is the best for South Africa? What is in our best interest at this point?
It is a very, very difficult question to answer, because there's a lot of political implications associated with that. It is not simply about a transaction or making sure that we get the best price. that decision from India could have knock-on effects, which we don't know at this point in time. And I'm sure that the government is considering that. And we need to think about, okay, if we do that as a short-term decision, what could be the knock-on effects? Could it mean that we are pushed out by some of our other counterparts, trading partners that we need, etc.? So it is not a simple question to answer, because again, the knock-on effects on other parts of the economy we need to take into account before maybe taking a step like that ourselves.
Well, Lulu, thanks so much for your time this morning. Chief Economist Lullu Krugel commenting on the anticipated MPC announcement this afternoon, and of course the speculation on possible interest rate increases that might come into effect if the South African Reserve Bank increases the repo rate. And it seems as though there is consensus among economists that we are likely to see one.